We want to thank today's sponsor, Age Up. People are living longer than ever, but few can actually afford it. With small dollar payments now, Age Up provides guaranteed monthly income for life beginning at the selected target payout age between 91 and 100. Head to age-up.com/that annuity show. That's age-up.com/that annuity show to get started and see how Age Up can help you guarantee supplemental income for yourself or for a loved one living past the ripe age of 90.
Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Here with my co-host, Mr. Ramsey Smith. We're missing, and I'll tell you, Will Moorcroft is somewhere out on the road, and Mark, unfortunately, I think got stuck. I think he's stuck in a virtual meeting someplace that couldn't join us. So, Ramsey, great to see you.
Always great to be here, Paul.
Excellent. And do you want to introduce our very special guest today?
Absolutely. So today we're joined by one of the most prolific thought leaders in the annuity space and retirement, Kerry Pechter. He is the publisher and owner of the Retirement Income Journal, which is widely followed by a broad variety of players in the industry. And Kerry and I have developed a dialogue in recent months, or probably over the last year or so, and I've learned a lot from him. And it was just very clear that we could have a very thoughtful conversation today about a number of things. So we're going to start with having Kerry introduce himself, and then really go into what he sees as most important in the industry, and then what I'm really interested in seeing, as we over the course of the conversation, is finding out how he's personally engaged in his retirement income decisions around annuities. So with that, Kerry, please tell us about Retirement Income Journal and your journey to where you are with with that important publication.
I started Retirement Income Journal in the depth of the financial crisis in 2009. That would be in March, because that's when the publication that I had been editing sort of crashed and burned in the retirement crisis and in the 2008 crisis. And so the industry came, I was becoming a premier writer and becoming very well known on the conference circuit as the editor of Annuity Market News. When it failed in the crisis, people came to me and said, "You've got to keep this going. The industry needs this kind of publication." And so I set up a content management system online, a platform, and started the publication myself. I had a pretty strong background in annuities that gave me a natural advantage over other media outlets. I had, from 1997 to 2006, I worked in the Vanguard Group as the writer supporting their annuity business and their retirement resource center, which required me to learn everything about retirement and annuities from the inside, which gave me an enormous perspective. Vanguard was also doing international business, was beginning to do international investment business with other countries, and that exposed me to the larger retirement crisis all around the world. So one thing led to another. I went from Vanguard to Annuity Market News, and then after Annuity Market News, I started this publication as a weekly and began traveling a lot to conferences and meeting just about everybody I could in the annuity business. And that's, so I've been publishing now weekly for 11 years and have been through two crises now. two financial crises and tracked a lot of changes in the annuity business.
So what do you see as the key issues facing the business right now? What are the one or two things you think are the biggest challenges now and in the near term?
Well, the big animal in the room, the elephant, the rhinoceros, the T-Rex, whatever you want to call it, is the low interest rate environment. And I had a conversation with a very senior executive at a very large mutual insurance company in 2009 when rates went down. And I asked him, how long can you folks deal with this kind of rate environment? He said 5 years. That was in 2009. We're now 10 years
Kerry,
later.
and what were the rates then? The 10-year was what? Maybe it was 3, 4, 5% at that point.
Well, at the point that I asked him, it was, I think it had gone down to the historically low. It was bottoming out.
Yeah.
And
it was probably around 2% or maybe 1.5%.
Okay.
But it wasn't as low as it is now.
No.
Well, maybe I asked him in 2010, but he said, we can do this for 5 years. Mm-hmm. That was a mutual company. So here we are, but the interest rate environment has been, the big picture is we've been living in Paul Volcker's world for the past 40 years. And so by 1997, it was in order to deal with the volatility in the interest rates and the falling interest rates that the fixed index annuity was invented in 1997. And so what we're seeing is in the insurance business, we're seeing various kinds of adaptation to both lower rates and the volatility in the market. So what you have now is the eminence of a product, the fixed index annuity, that can be handled with less interest rate exposure, less capital, and more stability than anything that they've tried before. Now, and then you have to. So that's where they are. I mean, I'll stop there for a second. It's the low. You have to look at the low rates, and then after that, you have to look at the different kinds of companies and how they deal with it. A mutual company is dealing with the interest rate situation differently from a publicly held company like a Prudential or a Lincoln, and or an AIG, and and they both deal with the situation differently from a private equity company, which has been in a position to take advantage of some of the volatility and the less nimbleness of their competitors in this environment, and their ability to do more with the slimmer spreads. So I'll stop there, and because there's a lot of different directions we can go from here.
Well, maybe we just sort of stick with interest rates because, we had a great interview with Bruno, another
Mm-hmm.
fan and friend of yours,
Mm-hmm.
on what this means long term. And again, I know just like you said, I've talked to my friends in some of these companies, especially mutual companies who I know are doing those kind of awful scenarios to say, well, if rates stay here, how long
Mm-hmm.
do we sell what we have? How long do we, what's the timeline? What's the scenario? It's a little scary when you start to hear this. I mean, the right question to be asking.
Mm-hmm.
How long will it be before you think you start to see major companies radically changing their annuity strategy? If
they are,
yeah,
they have been. There was a time not very long ago when the annuity industry thought that the variable annuity with the living benefit was going to be the killer app, and it was going to spread into the 401k plans, and it was and in a way at the time at one point the variable annuity with a living benefit looked like the perfect product. And in the insurance world, the perfect product is a product to which all of the purchasers objections can be met. And so in the annuity business, the upside potential, the lack of upside potential, and the illiquidity of the fixed income annuity were barring the development of the retirement income business. So you come back with, after much trial and error, you come back with the variable annuity with either a living benefit or an accumulation benefit or an income benefit guarantee, some kind of life insurance related guarantee, and that was beautiful. And then along came the financial crisis, and people stuck with it for a while after that, and then it became just too much. People bailed, and so then it becomes, well, what do you sell now, and what can you offer people that they're actually going to buy? And so we've seen the last 10 years is adaptation to that.
No, and I agree. I mean, I got my start in the insurance industry, in particular, focused on variable annuities. I remember Ramsey left this call. I remember a conversation with one of our channel managers saying, "Well, why should we do it at this 8% roll-up rate, guarantee roll-up?" Well, 8's better than 7. Like, okay,
8 sells.
signs that we may be headed for some trouble. At that point, Kerry, if you remember that, I mean, all the VA players just hated these FIAs. Now, there were some, I would say the structure of these FIAs have changed. They're more consumer friendly. The surrender charges have come down and stuff. But, in some regards, as you say, the design, and I'd be curious from your perspective, when I talk to people, I say, well, what the FIAs did was allow people to offer the retirement income, carriers to offer retirement income products, but manage them like they were whole life products, where you've got the ability as an insurance company to, adjust caps, adjust participation rates, adjust spread. So you've taken a little bit of that risk off your own balance sheet. Now, you think is that a fair depiction of why FIAs have caught on with so many carriers over the last 5 or 6 years?
Well, of course, they had problems. That the FIA came out of the independent agent channel, and a guy named Bob McDonald, I don't know if anybody remembers him.
Oh, yeah.
He's very alive and kicking. Bob McDonald created a massive business with Life USA by driving the distribution with incentives and by stirring up a ton of independent insurance agents. And with the insurance, that's like selling Ginso knives. The independent agents. I mean, you just get a zillion independent agents to sell one policy each to their relatives, and that's, and he did that like crazy, and he built the business, and then he sold it to Allianz Life, and so Allianz Life then mastered the indexed annuity business, and so it gradually worked its way in. Now, at the same time, the traditional insurance companies, I don't think that they really, structured products was not really their thing. Dealing with, it's a spread business. It's a general account business. Buying options, actuaries are not quants. You had not only a cultural, but a skill a barrier between the indexed annuity and a distribution channel barrier, a skills barrier, a culture barrier. I mean, so the rest of the industry came to it, I would say, kind of reluctantly. Gradually, the indexed annuity became the only thing that was selling, and it sold partly because its core appeal was simply that it could produce more income, or it could produce more yield than what it was competing against, which was certificates of deposit. And then it spread into they started adding making it more of an income product by adding the lifetime income, and it could order offer more lifetime income than the variable annuity because it carried less risk. And so they could offer, it also had higher lapse rates, which made it possible to offer, I don't want to get into the weeds too much here about all the inside baseball about what drives the offerings in retirement in the living benefit space, but the industry had to come around to the indexed annuity because that's simply what was selling, and it just required so much less capital. There was just more room for it.
You're absolutely right. So, I spent 10 years of my prior career, addressing precisely those two sets of risks for life insurance companies. And the risk associated with variable annuities was enormous, unpredictable, and not entirely hedgeable. Whereas the risk associated with an FIA is very hedgeable and very clear. And so you can essentially, through the purchase of derivatives that replicate whatever payout function, your crediting method you're promising, you can essentially reduce the risk to something that approximates a standard fixed annuity from an actuarial perspective. So you're absolutely right. All the things come together. You get a chance to reduce risk. You're able to create something that has the commercial appeal for the end users and focuses on income and potentially more income. So it's been a remarkable turn of events. And now there's a new class of these that you've written about, which are the index variable annuities. Some people call them RILAs. What are your thoughts on those?
Well, that was a natural progression. There was no reason except there was a little technical hurdle to be the transition from it was not simply a product extension to go from fixed indexed annuities to structured variable annuities, because the fixed index annuity can be sold by insurance agents without security licenses. The structured variable annuity, because it allows for downside loss, because there's downside risk, it cannot be a pure insurance product and must be registered with the SEC and sold by. So you switched. A lot of things had to change in that product development.
Yeah, let's focus just on the value proposition. Do you like the value proposition as in terms of the? I know that there's some channel shifting that has to happen in order for them to be sold, but if you put that aside, is the value proposition to the end user? Do you think it's a step in the right direction? Do you think it's a good addition to the quiver of products that are available?
Well, I think it's a terrific product for what it's built for. Why wouldn't I think it's a definite? But what has it got to do with retirement income?
Ah, okay. So why don't we take the opportunity to segue into that, if we could? You have talked a lot about, at least in one of the recent articles that you shared with us, you've talked about the importance of income planning, specifically why it's so difficult. Can you talk a little bit about that? Why it's difficult and how one should think about mixing insurance and investments to get to the right answer?
Okay, there's a couple of pieces of this. There's a behavioral piece. There's a sort of a mathematical financial piece. Not sure which one to start with.
Behavioral. I vote behavioral. Paul,
behavioral. Okay.
Yes.
Behaviorally, every person's everything. It's a unique situation. Everyone needs a different kind of retirement income plan, because there's so many different parts of the household balance sheet that have to be integrated, and that it requires a different kind of advisor. It requires a more consultative advisor because you have to really listen to people. The typical advisor, a successful one advisor or a rep or an insurance agent, generally has a plan that they take to the client, and they know they have a specific endpoint that they want to get to, whether it's a closing or if they're running their business efficiently. They know what they specialize in. They have an end goal with every meeting. They have a certain number of meetings. They have a plan. With retirement income advice, you have to pretty much, I think, I'm speaking partly as a consumer because I never sold anything, entirely as a consumer. You have to sit there and you have to listen. You have to listen a lot to, and it has to be open-ended. And this is a completely new approach to people who are used to closing. And from the consumer end, you don't know anything. You still have to be led by the advisor. The advisor has to know where you're going, but in an open way instead of a closed way, if that makes sense. You've got to know about your home equity, got to know about your relatives, to your stray child or nephew that going to need support, your health, all the things that advisors are not used to talking about. These things have to be heard from the customer and responded to. And I'm a big believer in the household balance sheet approach. It's more than just investments, especially when people don't have a huge amount of investments. Then you definitely have to start exploring other assets.
So I hear you advocating for an important financial planning element of the process. So either the advisor has to have a financial planning skills, or needs to bring in a financial planner to the discussion, right? According to your model.
Not everybody can afford that, and the advice is built into it. It's like a prepared food product instead of a chef-made food product. And if people don't have enough money, I don't think there's anything wrong with them getting a variable annuity where they can switch on optional income. So you have different you have from the advisor's point of view, one of the things that makes this hard is you've got the wealthy investor, you've got who's overfunded for retirement, you've got the middle class investor who sometimes is constrained, and then or is sort of on the balance between and may not be able to, he might have trouble affording the lifestyle that he wants in retirement, or she. And then you have the very constrained investor, and you have to treat all of these differently. So you have to know who you're talking to, what their assets are, and what their sensitivities are, because they face, there are like 8 kinds of risk that people face in retirement: health risk, inflation risk, market risk. How do you match your assets with your liabilities? It's complicated.
Yeah. So Kerry, thanks so much for joining us on our show today. I'm going to kind of throw, one of my favorite Kevin Kelly quotes. Kevin Kelly was one of the founding editors of Wired magazine, and he said, famously sort of said, based on kind of what the internet was going to enable in terms of businesses, that if you could create a business where you had 1,000 true fans, you could actually build a business. Now, you've got 1,000 fans. It's clear. We talked about this a little bit after the show. You were kind enough to put me or feature us in one of your articles, and I just, the people who came back and saw it was a very diverse group of people. Tell me, if I'm showing up to the Kerry Pechter show, what are the qualities of you that make me want to really engage and listen? I think it's very evident your thought, your education commitment, thoughtfulness around the business. But what is the draws so many different people to you and the work you're doing?
I set out to, my principle from the beginning was, we may say all kinds of nutty things to the public, but we really should be frank with each other. So when you come here, you're going to be talking the way you talk, the way we talk to each other. And I was fortunate enough to having worked in the industry myself, or I would never have been able to do that. So I'm kind of a bridge, and I saw no purpose in doing it any other way. And it was going to be, and I wanted to create at least an island of that so that people would have some place to go. And I had a feeling that out of 100 insurance companies and 300,000 advisors, that I could find 1,000 people. And then I went with a subscription model, which enables me not to, be a slave to the other model.
Oh, this is terrific. I guess my very last question, Kerry, is, okay, where do we find you? retirementincomejournal.com. Is that the best place to go to connect with you and follow the work you do?
Yes, go there, sign up for the newsletter. The newsletter is free, and you get 6 free articles before you hit our paywall. And we are subscription supported, which means that we don't want any free riders out there. We can't exist unless we're supported.
Ramsey, last thoughts, last questions. Yeah.
No, I think we covered a lot of ground, and at some point I hope we can have you back, because I think one of the very interesting things that you've written about, and so I'll leave this as a cliffhanger for a future conversation, is that you travel to other countries, spend time there, long time, understand their retirement systems, and you write about it. And I think especially the work you did in Israel, I found particularly intriguing. So thank you for coming today, and hope we can have you back at a future date to talk about one of the many other things that you talk about with your audiences.
It's a very broad, I call it it's a narrow niche, but it's a very deep one.
Indeed. Don't we know that? All right. Well, listen, thank you very much, Kerry. And thanks all of you for listening to our show. Please tell your friends, like us, subscribe to us, give us reviews, and be sure to tune in again next week for another episode of That Annuity Show. Thanks, Ramsey. Thanks, Kerry.
Right. Thank you. Bye-bye.
Bye, guys.
Hi, this is Ramsey Smith, co-host of That Annuity Show and founder of Alex.fyi. I want to talk a little bit about AgeUp. They are our first sponsor here on That Annuity Show, and they have a very unique and innovative product. As most of us know, people are living longer than ever before. Unfortunately, fewer and fewer can afford it. With small dollar payments now, AgeUp provides guaranteed monthly income for life, beginning at the selected target payout age between 91 and 100 years old. Head to ageup.com, that's age-up.com/thatannuityshow to get started and see how AgeUp can help you guarantee supplemental income for yourself or a loved one living past 90.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.